Greetings and salutations. Today we're going to look at the company Bank of Nova Scotia, headquartered in Canada, and traded on Toronto Stock Exchange and New York Stock Exchange under the ticker BNS. Please stay tuned for the important disclosure information at the conclusion of this video. The Bank of Nova Scotia, or Scotiabank, is the third or fourth largest Canadian bank. The bank is one of Canada's Big Five banks, which together control more than 90% of the market and operate across the country. Scotiabank was founded in 1832 and claims to be Canada's most international bank due to its heavy presence in the Latin American region. While only 50% of revenue is coming from Canada and 10% from the United States, the solid 40% is due to the operations in the Latin American region, mostly in Mexico, Peru, Chile, Colombia, and Brazil. Given the nature of the business, the currency used in 40F reports, and relative stability of the Canadian dollar to the United States dollar, this analysis is produced in Canadian dollars. All numbers you will see in this report are Canadian dollars unless specified otherwise. The intrinsic value analysis of banks is very different due to the nature of business and accounting records. Banks obtain equity by issuing shares or retaining earnings. They also attract deposits and issue debt, for which banks pay interest. Funds from equity, deposits, and debt are being used to generate revenue. The ratio of deposits and debt to equity is of paramount importance, as it increases the leverage of the bank, thus allowing greater revenues and simultaneously producing greater risks. The bank must set aside a portion of funds in the form of liquid assets, for which it will be able to collect interest. The rest of the capital bank issues as loans that also yield interest, but sometimes fail and result in credit loss in the form of net write-offs. On top of that, banks are engaged in daily operations that yield non-interest income. All of the above result in the non-interest operational expense. Net income is mostly spent on dividends and equity growth, as well as on repurchasing shares, acquiring existing businesses, and other. Please note the numeric notation, as you will see it in the slide titles for the ease of navigation. Our bank evaluation starts with equity. We can divide the history of Scotiabank's equity growth into 4 periods. The first period is from 2005 to 2010, a period of high real equity growth, net of share issue, at 9.3% per year. Second period, 2011 to 2013, the real equity growth slows to 7%, however on top of it, the bank issues new shares at the rate of 8.4% per year. In the third period, 2014 to 2018, the growth continues at 6.6% per annum, without any new shares being issued. Finally, in the fourth period, starting in 2019, we see a dramatic stall in real equity growth to slightly below zero. Based on the available equity, banks attract deposits from households, businesses, and governments. Deposits to equity ratio plays a crucial role in determining most of the bank's leverage. Scotiabank had this ratio at about 13 in the late 2000s, slowly reducing to 10 by 2018, and by 2023 returning to 12, a long-time average. Along with deposits, to leverage up, banks issue debt. Debt is more flexible to quickly issue and redeem. The combination of deposits and debt to equity ratio ultimately determines the leverage of the bank. With an average of 15, we saw the highest in 2007 at 18 and the lowest in 2018 at 12. In 2023 it was aligned with the average at 15.1. Debt is only about a quarter of attracted deposits and serves as a counterbalance to have a more stable leverage ratio. Equity, deposits, and debt altogether serve as total capital the bank can work with. Attracting deposits and debt entails risks. A portion of this capital must be set aside for liquidity and financial stability of the bank. The ratio of liquidity assets to the combination of debt and deposits averaged around 0.42 to 0.43. The 2023 value is at 0.43. Most of the remaining available capital is issued in the form of loans to households, businesses, and governments. Loans are the major source of revenue for banks. We can see capital allocated for loans growing somewhat in step with equity and deposits growth till 2013 between 9 and 12% per year, with a significant reduction to just 4.3% since as of 2023 the ratio of debt plus deposits to equity returned to a long-time average of 15, and liquid assets to debt plus deposits is at a long-time average as well. We can expect further loan growth to be in step with future equity growth. Finally, let's look at net income and capital allocation. Net income grew rapidly at about 8% per year between 2005 and 2018, then slowed to about 4% in the next 4 years, and in 2023 showed a dramatic drop to the net income levels back in 2016 to 2017. We will need to investigate this decline. Additionally, we will need to investigate the period of rapid share issue between 2011 and 2013, why the bank issued more shares, and how the capital was allocated. The 95% of net earnings since 2005 was allocated equally divided between dividends and equity growth. The remaining 5% we will put in a bucket, other, and note that most have happened between 2019 and 2022. This will be our third investigation. Let's start with the drop in net income in 2023. As we can see, the revenue of the bank consists of income from loans, 64%, income from liquid assets, 17%, and non-interest operating income, the remaining 20%. Bank expenses 56% is deposit interest payments, 5% is debt interest, 30% is non-interest operational expenses, 4% is tax, and 5% is provision for credit losses. Income from loans contributes 64% to the total revenue. All loans are directly tied to the central bank interest rate, with a few percentage points on top of it. If the central bank interest rates change, it takes time for the asset performance to gradually adjust to the new rates as customers renew their loans. As for the loan mix, residential mortgages are about half of all loans issued. Historically, they charge an additional 2.8% on top of central bank interest rate. Business and government loans, 30 to 40% of the loans mix, also with a 2.8% additional interest rate. Personal loans and credit cards are 15 to 20% of the remaining loan mix, and charging an additional 6.5% interest on top of the CB rate. The total mix of all assets is expected to produce an interest rate equal to the central bank rate plus 3.4%. Issuing loans is directly connected to the risks of loan defaults. Historically, we saw about 5% of the total expenses of the bank spent on loan defaults. That is about 10% of the revenue from the loans themselves. In 2023, this number is just 7.6%, not much higher than in previous years. More specifically, residential mortgage defaults account for about 1.6% of the income between 2005 and 2023, with spikes in 2008 and 2020 to 3.9 and 4.5% respectively. Personal loans and credit cards expect to lose 22% of the income they generate, with a historical spike in 2020 at 46%. Business and government loan interest income was diminished by 5% for defaults, with a 16% spike during the pandemic of 2020. The so-called stability buffer, in the form of liquid assets, delivered about 17% of total bank revenue. These liquid assets consist of trading and investing securities, about half to two-thirds of the buffer. Deposits with other financial institutions, about 20%. And the remaining in the form of resale agreements, also known as repurchase agreements or repos. Resale agreements are a form of short-term borrowing by other banks. The performance of liquidity assets is almost entirely dictated by central bank interest rates with a lag. The deposits the bank attracts come primarily from three sources. The interest paid on them also heavily depends on the central bank interest rate with a lag. Business and government deposits account for half to two-thirds of all deposits. The bank pays CB interest rate plus 0.4%. Personal deposits are an additional third of deposits. The interest rate is 0.6% on top of the CB rate. Deposits from other financial institutions, mostly banks, account for the remaining 5 to 10% of the mix. The interest they get is slightly above the CB rate. Overall, based on the mix, we can expect about 0.4% interest paid on top of the CB rate. The debt the bank attracts for operations contributes only 5% of the total expenses. The interest paid for it can be expected at the level of central bank interest rate, with a lag. One of the most interesting discussions of this analysis is the model of the interest rate adjustment lag. Since 2005, we have had several periods of hiking and lowering central bank interest rates. Bank loans, liquid assets, deposits, and debts adjusted to the new rates with a lag. It is logical, since for example, Canadian residential mortgages are often issued with a fixed interest rate for several years and have to be renewed after. Another example is the deposit interest offered by the bank, as the competition between banks can prevent lowering it immediately after the CB rates drop. We built a regression model to predict the change in real banks' interest rates on assets and liabilities after the change in the CB interest rate. Based on different combinations of inputs, we tested several regression models to minimize the prediction error subject to bias variance trade-off. Please note, since we have only a few data samples, we can't be highly confident in the accuracy of the model. We built separate regression models for assets and liabilities interest rates. The models chosen for this analysis were linear regressions based on 4 inputs: expected interest rate, partially based on CB rate change this year, last year, and 2 years ago. Please see them on the slide. Stay tuned, as we will discuss the expected interest net income in the upcoming slides. For now, let's evaluate operating non-interest income. Non-interest income comes mostly, about a third, from banking services, which are subscription payments, paid transfers, and overdraft protection fees. Other additional major categories, about 1/6 each, include banks' mutual fund management expense ratio charges, wealth management services, trading and investing operational income in the form of transaction fees. The remaining 25% of non-interest income consists of the remaining categories: currency exchange fees, advisory fees, insurance fees, and others. The historic growth rate of total non-interest income since 2011 was about 4.2% compound annual growth rate. Yearly inflation during those years was about 2.3%, making the real growth of about 1.9% per year. Moreover, the growth was not even, with periods of stagnation. You might notice that 2023 results of $14 billion are almost the same as the number in 2019, 4 years ago. Based on the growth by category since 2011 and since 2019, we estimate that non-interest income can grow at a 3.8% nominal rate or 1.5% real rate, assuming the inflation returns to the historical trend. Operational expenses and taxes, as a proportion of interest and non-interest income combined, were stably hovering around 59 to 69%, with an average of 63 and a current value of 66%. About half of these expenses are salaries. Government taxes, technologies, and amortization form another third. Now, we can put together this jigsaw puzzle of a drop in net income in 2023. As we discussed before, operational expenses and revenues, taxes, and provision for credit losses all appear to be within historic norms, albeit the provision for credit losses increased by $2 billion. The major reason for lower net income in 2023 is the lag in adjusting interest income to new central bank interest rates. Using historic interest rates for the current mix of assets and liabilities, we can expect net income to be higher, at around $14 billion, almost double the reported. Obviously, because of the lag, we will see higher interest-based income in the upcoming years, even if the central bank drops the rate in the future. In the second investigation, we will examine the period of rapid share issue between 2011 and 2013. Scotiabank issued shares for $9.5 billion, increasing its equity by $7.1 billion, which is about 75% of the amount. The remaining $2.4 billion, or 25%, was spent on acquisitions. During these years, the bank spent at least $6.5 billion on major acquisitions. Apparently, some of these acquisitions were sponsored by share issue. The decision to engage in share issue between 2011 and 2013 appears to be strategic. It is during these years we saw relative strength of the Canadian dollar and relative expensiveness of Scotia Bank measured by the price-to-book ratio. In the third investigation, we will look at the allocation of capital into the other category during the 2019 to 2022 years. Being not a significant category before 2018, it cumulatively absorbed about $6.9 billion by the year 2022. It turns out, it is during these years, we saw significant and almost perfectly matching losses in other comprehensive income in the 40F report. Some of these losses can be explained by the changes to the fair value of assets held in rapidly depreciating Latin American currencies. However, most of it is the unrealized losses on the U.S. and foreign debt instruments, about $4 billion. If the bank holds these debts till maturity, most of which will be happening in the next 5 years, these paper losses might be never realized. In either case, the bank already adopted to the new norm and showed no loss of allocated capital in the other category in 2023. Finally, we can look at the big picture of the intrinsic value of Scotia Bank. It is the third or fourth largest bank in Canada, with half of its revenue generated locally. It operates in all provinces of Canada, and some people might consider it too big to fail. 40% of the revenue of the bank is diversified away from Canada and the United States into the Latin American region. It also has a non-trivial presence in the United States, allowing for greater diversification. Historical growth of the real, inflation-adjusted, net income of the bank, measured by 3- and 6-year rolling compound annual growth rate, showed a significant decline by year 2021 to about 3%. In comparison, the real growth between 2005 and 2021 was 5.5% per annum. A few years back in 2018, 3- and 6-year rolling annual growth rate was 4%, down from 6% since 2005. Since 2021, we saw a stagnating and even falling net income. The most likely explanation is the rise of interest rates. On one hand, this was leading to losses in the other comprehensive income category, mostly consisting of unrealized losses in debt instruments such as bonds, which ended in 2023, as we discussed in the previous slides. On the other hand, we saw a lag in net income. Once the lag income catches up, we can theoretically see a net income of $14 billion, much higher than the 2023 $7.6 billion reported. A net income of $14 billion would indicate a real net income 6-year rolling growth of 6% per year. The bank was overall very successful at allocating about half of the accumulated net earnings into dividends and the other half into equity growth. Overall, the bank is well balanced on all ratios we discussed in this analysis. The intrinsic value model for banks has to be associated with dividends. In 2024, banks' dividends are projected to be $5.2 billion, or $4.24 per share. If we apply a 5.5% discount rate, the intrinsic value with 0% real dividend growth indefinitely yields $77.1 per share, an implied PB ratio of 1.15. Growth of 3% yields $169.90 per share, an implied 2.53 price-to-book ratio. And a growth of 4% yields $282.70 per share, an implied 4.22 PB ratio. The historic real, inflation-adjusted, dividend growth till 2024 was 1.5% since 2021, 4% since 2005, and 7.1% since 1989. 1.5% might appear as a significant slowing down. However, we must be mindful that a 50% capital allocation from the expected net income of $14 billion, based on the asset mix, without an adjustment lag, would result in higher dividends per share of $5.70. This would bring real dividend growth since 2021 to 12%. The big question is the potential damage to the banks by a possible recession in Canada, especially in real estate. For this, we will use the paper published in 2022 by the Central Bank of Canada. In this publication, authors modeled a severe recession and its impact on banking assets. In a hypothetical scenario, over 1.5 years, Canada sees a contraction of real GDP by 5.8%, unemployment peak at 13.5%, and housing prices decline by 29%. In this event, authors suggest the bank loss of 34.8% of its credit card loans, 9.2% of other consumer credit, 0.7% of uninsured mortgages, 6.3% of business loans, and 8.2% of non-residential mortgages over a period of 3 years before stabilization and recovery. For Scotiabank, that equates to approximately $37 to $43 billion. That is roughly 7 to 8 years' worth of dividend payments, or about $27 worth of value per share. Please note that Scotiabank is Basel III compliant, which is one of the strictest regulations for bank sustainability. Therefore, we assume that the bank will be able to withstand this severe recession and even continue dividend payments, albeit at a lower rate or at the expense of the future equity growth. International investors should also be mindful about the United States to Canadian dollar historical exchange rate, as, in the past 50 years, it has bounced between 1 and 1.4, with the current readings of 1.38. Thus, if the exchange rate mean reverts, we can expect to add an extra 15 to 25% of the intrinsic value in the United States dollars. Canadian investors should be mindful of favorable eligible dividend taxation for the tax residents of Canada. The exact calculations are complex, and we will not discuss them in detail. However, we are going to provide 3 examples of individuals making $43,000, $80,000, and $120,000 per year through employment income and their eligible dividend tax advantage. In these examples, the intrinsic value can be augmented by about 10 to 15% for Canadian tax residents. Please note, this is not tax advice, and this channel insists on consulting with your lawyer about anything discussed in this video. Finally, let's look at the numbers. In the scenario of 0% real growth of dividends indefinitely and a severe recession that starts on year 1, the intrinsic value of one share is estimated at $50. Without the severe recession, this number is $77. The implied price-to-book ratio is 0.75 and 1.16 respectively. A gentle reminder, everything discussed in this video was in Canadian dollars. With a real dividend growth of 3%, without a major recession, the intrinsic value of the bank is estimated at $170 per share, an implied price-to-book ratio of 2.56. On top of these numbers, we can potentially add 15 to 25% for the mean reversion of the Canadian to American dollar exchange rate, and an extra 10 to 15% for favorable taxation of eligible dividends for Canadian residents. Have we ever seen a PB ratio of 2.56 in the past? Yes, in the table below you can find the PB ratios of all major banks of Canada and their PB ratios by year since 2002. Scotiabank saw a PB ratio of 3.5 back in 2005 and is currently being traded at 1.1, which suggests an attractive valuation. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.